Hello, and welcome to today's webinar, Is Your Business Built for Success? Make sure you are on track for continued success. Brought to you by Pest Management Professional Magazine and our sponsor of the event, Pest Pack by WorkWave. I'm Danielle Pesta from North Coast Media, the Digital Media Manager for Pest Management Professional, and I will be your event manager for today's presentation. Before we get started, I want to let you know that today's webinar will be recorded. You are currently in a listen-only mode. A recording of this webinar will be posted to mypmp.net/webinars and will also be emailed to you tomorrow. At this time, I'd like to get you comfortable with our console and the ways you can participate during today's webinar. Please notice the Q&A panel on the left-hand side of your console. If you have a question, type it in the panel's text box, then click Submit to place your question in queue. You may also use the hashtag PMPWebinar on Twitter to submit questions during today's event or to enter into discussions with other attendees. We encourage you to ask and enter any questions you have for our speaker during the presentation. We will address the questions at the end of the presentation during the Q&A portion. Anything submitted during registration has already gone to our speaker and may be covered during the live event. If you experience any technical difficulties today, you may use the same Q&A panel on your screen to submit your issue, and technical support specialist Ellen Wagner or I will personally assist you. You can learn more about today's speaker by viewing their photo, bio, and contact information in the panel located in the upper left-hand corner of your console. If you are logged in to your social media accounts, you can share the webinar's title, description, and URL with your friends or colleagues using the Share This widget below the slides. In the bottom left corner of the screen, the Refer the Colleague panel will allow you to email today's webinar information to a coworker or other industry professional. Finally, at the bottom right of your console, you'll find a PDF of today's presentation slides, which you can download, and a link to learn more about Pest Pack. Now, I'd like to introduce today's speaker. Today, we will be hearing from Dan Gordon, CPA, founder and owner of PCO Bookkeepers, an accounting and consulting firm that caters to pest management professionals throughout the United States. At this time, I'll turn the presentation over to Dan, who will kick off our event today. Dan, take it away.
Thank you. Okay, so let me just give you a brief overview of who we are and what we do. So we have an accounting firm that caters to pest control companies. We are in New Jersey. We also have an exit planning company that facilitates transactions for those who are looking to sell out and or pass on to the next generation. So we're an accounting and advisory firm obsessed with providing pest control companies the information they need to prosper in today's competitive environment. I'm pretty proud of that. And exit planning, we've done scores of transactions worth hundreds of millions of dollars. And our clients, our accounting clients, span 47 states. And if you add them all together, all the annualized revenue, it's over $850 million of annualized revenue. So when I give some of our facts and figures, they're based off of numbers that come from our database, and we have enough information to have a good understanding of the industry, the line items on your P&L, and comparisons. And finally, we specialize in pest control accounting. So let's talk about what it takes to be a best-in-class company. Is your company built to last? And I was asked to come up with a few KPIs or a few items that I thought would be, if I were running a pest control company, these are the things that I would want so that I have long-term sustainability, but also profitability and build the value of my business. And I actually came up with 4 of them. So the first one is gross margin, and we'll go into that. pretty extensively. For those of you who have seen me speak before, I speak about gross margin all the time. It's probably the single most important KPI in any business, but more particularly in pest control businesses. The second is annual cash flow to ownership, and we'll talk about that. And then one that's kind of obvious, but I'm going to go into some examples about why it's so important, is the recurring to non-recurring portion of your revenue, and then annualized growth. Now, all the examples that I'm going to give and the numbers that I'm going to pull out really are part of analytics, and they come from programs like PestPack and or QuickBooks. So what we're trying to do is pull the information out of our PestPack as it is an outstanding database, and we're able to use that information so that we can calculate our KPIs and or play what-if games. So, for those of you who don't know, what is gross margin? Gross margin is revenue minus direct costs. Revenue minus direct costs is gross profit, but expressed as a decimal, it actually is gross margin, okay? So, when we talk about gross margin, we're talking about the revenue, which is obviously your commercial, residential, wood destroying, bed bug, anything else that you want to look at. We like to break our revenue down into a couple of categories. That would be like the startups, the one-times, and the recurring revenue. We think that that's important, and we think that you should have it broken up by division. That would be the residential, commercial, wood destroying, etc. And when we take our total revenue and we subtract direct costs are those costs that happen on the road. That's your technician wages, their payroll taxes, their benefits. That's the vehicles that they drive in, the fuel that goes in the vehicles, the chemicals. That would be anything. If you think about, if it happens on the road with a technician, then it's a direct cost, okay? If it happens in the office, then it's a fixed cost. Okay, so revenue minus direct cost equals our gross profit. Expressed as a decimal, it's our gross margin, okay? So what I want to do is, I have a unique perspective on the industry in that my background is accounting, and prior, long time ago, I worked in a factory as a cost accountant. And so we look at, what does it cost to produce a unit of, whatever we're manufacturing. And so when I look at gross margin, I say that business is a manufacturing process, right? So maybe if I'm in the candy producing business, I'm producing candy bar. But in the service business, we manufacture hours of service. And the question is, are those hours of service profitable? Okay. So let's take an example. This example would be a company that manufactures and sells dining room chairs. Okay, so the company is ABC, and it sells dining room chairs at a price of $800 each. And the direct cost and the cost of goods sold, or the expenses, include, and these are direct costs, right? So we need some wood, that would be $40. We need some fabric for the chair, that would be $8. We need some wood stain, screws, and other small materials, that's another $2. And then we need some hourly labor to assemble the chair, to paint the chair, to put the fabric on the chair. And then we need to ship the chair out, and that was $16. So it's $40 plus $8 plus $2 plus $200 plus $16, okay? So what does that give us? That gives us that our total cost of goods sold, or our total direct cost, is $266 per chair. And that gross profit is $534, the 800 minus the 266, or a gross margin of 66.7%. Okay. The reason that gross margin is so important is it determines what our break-even point will be, right? We're making 66.7% on each chair, but that's not really the profit. That's known as a gross margin or a contribution margin, and that contributes to paying off all the fixed costs. And once the fixed costs are paid, then we start making money at a rate of 66.7% of each dollar over the break-even point. Now, rather than confuse you with break-even point on the manufacturing process, I'm going to go right into gross margin for pest control and show you how that's calculated, and we'll talk about that. What's really interesting about this is I've done this comparison before, but have updated it significantly for what's a function of the economy right now, which is inflation. And our inflation has increased wages quite a bit. In fact, most of our clients, the average technician is making $20 or more per hour. But let's take a look at that $20 an hour guy or gal, and how much does it really cost? So the salary cost is $20 per hour. We have 40 hours in a week and 52 weeks in a year. So that $20 times 2,080 hours, right, at 40 hours a week, is $41,600. Let's also say that this technician works overtime of 7 hours a week, okay? So we've got to pay him or her time and a half or $30 an hour times 7 hours times the 52 weeks. And that's another $10,920. So this particular technician who makes $20 an hour and works 47 hours a week makes $52,520 for the year. Now, that's what that's his gross wage or her gross wage, and obviously he or she has to pay payroll taxes and other taxes on it, so they make considerably less. Let's call it $40,000 or $42,000. Okay, but it costs us $52,520. In addition, we have to pay our side of the payroll taxes, or FICA, which would be $4,018. SUTA, which is state unemployment tax, $426, depending on what state you're in. FUTA, which is federal unemployment tax, that's $62. Workers' comp, and this varies state by state, but I use $3,676. And medical benefits of $12,000 a year. Obviously, your numbers will vary, but you can use this chart to look and see what does it cost you to have a tech on the road. So if I add all that together, my $52,000 technician cost me $72,702. Remember, my technician probably is only taking home about $40,000 or $42,000 because he or she has to pay his tax. Costs us $72,000. Now, if I add uniforms for $500 in a year, if I add a truck lease for $600 a month or $7,200 a year, if I add insurance of $150 a month or $1,800 a year, if I add maintenance of $900 a year, if I put in fuel of $9,600 a year, and again, that number used to be lower, and it could be higher based on what's gone on with fuel pricing. It seems that fuel pricing is coming back into a normal range, but for a while there, it was pretty ugly, okay? And if we say that our chemical usage in that truck is $20,000 for the year, plus I add my $72,000, my total variable cost is $112,702. In other words, that's what it costs me to put a technician on the road with their truck, with the chemicals, uniform, et cetera, et cetera. So it cost me $112,702. Not to digress, but sometimes people bring me companies who they say that, gee, I want to sell my company. What's it worth? And they'll say they're doing $1 million and they have 10 technicians. Well, you can see that they're losing money if they do $1 million and they have 10 technicians, right? So a technician should be doing probably well in excess of $200,000 a year, okay, just to make a decent profit. But let's take it a step further, right? Let's say that this technician works 47 hours a week times 52 weeks are 2,444 hours. Let's say that we give them 2 weeks of vacation or 80 hours. Let's say that we give them 10 days of holidays, which is another 80 hours, and sick time of 4 days, okay, which is 32 hours. So now my total time available production is 2252. If we use a route density percentage or a utilization of 60%, in other words, if our technician is on the job for 60% of the time and in the vehicle behind the windshield for 40% of the time, which on a residential route is probably okay. It's not great, it's not terrible, okay? And how do you calculate that? Especially in PestPack, you can calculate that using your employee production reports. You'll get the number of hours, and then you'll also use your time cards or the amount of time that your technician was punched in. So if he's punched in for 40 hours and he's on the job for 30 hours, according to the production report, that would be, he'd be utilized 75% of the time. But 60% is okay. It's not terrible, it's not great, okay? So if I take my 2,252 hours and multiply times that 60%, I get 1,351 hours that he is on the job or she is on the job. Now, if I take my prior slide, that 112,702, and I divide it by the 1,351 hours, my total variable cost, this is not fixed, this is my variable cost per hour, is $83.42, okay? Now, let's look at what happens when I have $83.42. Well, in the example of my chair that I sell for $800, cost me $266 to make it, and I have 67% gross margin, okay? And if I say that my fixed cost per month is $100,000, my break even in dollars is $150,000, and I have to produce 187 and a half chairs in order to break even. After that, I start making money at that $533 per chair. Well, let's move this to hours. So let's pick some sale prices or some dollars per hour that we want to get. We're going to use $100, $125, $140, and $166.84. Now, you could look at this as, if I offer quarterly service, this would be $100 per quarter, or $125, or $140, or $166.84. If I know that my cost of goods sold is $83.42, that means that at $100, my gross margin is 17%, okay? At $125, my gross margin is 33%. At $140, it's 40%. And at $166.84, which is a pretty highly specific number, obviously I did the numbers, I doubled this, and that's 50%, okay? Again, same $100,000 a month of fixed cost. Well, what that would mean is that I would need, at $100 an hour, I would need to do $603,000 in order to break even. At $125, it would be $300,000. At $140, it would be $247,000, and at $166.84, it would be $200,000. Does everybody see that? Basically, in pest control, best-in-class companies have a gross margin of 50 to 55%. In order to keep the illustration clear, I did 50% of 83.42 or 166.84. That means that if I produce $200,000 and 50% of that goes to the direct costs, that means the other 50% or the other $100,000 goes to pay off the fixed cost, and I break even. So my break even units per month or hours is $1,198. Now, let's say that I only have 113 hours to work with for each truck, which makes sense, right? That's my 1,351 hours divided by 12 months. So the number of trucks I need to break even at $100 is 54. The number that I need at 166 is 11, right? We went up by a little over a third, but we reduced the number of trucks significantly. That's because of this gross margin. We're at 17% versus 50%. Okay, analytics. How do we improve this or change this? The first thing that we do is we try to make the utilization go up, meaning that our windshield time is 20% instead of 40%, making our total available hours to work 1,802 rather than the 1,351. Using the same variable cost divided by 1,802, my variable cost is now 62.54. And going back to the last slide, if I wanted to have a 50% gross margin, that 62.54 would be roughly $125, right? So this 166.84 would be 125. So how do we fight inflation? There's nothing we can do about the wage inflation. There's not a whole lot we could do about fuel inflation or material inflation. However, what we can work on is either our route efficiency and or our selling price. Both have the same effect. In other words, if I sell at $100 an hour and I increase my selling price to $120, but my cost of goods sold remain constant, right? That means that my gross margin will rise. The same thing happens when my route efficiency goes from 60 to 80 or in some manner goes up. So that's how we battle inflation. And that's, this is probably the single most important KPI within the service industry that you've got to be watching, okay? Best-in-class pest control companies are at 50 to 55% gross margin. We definitely have clients that are 60% and over, okay? If you look at a lot of door-to-door companies, they usually have very high gross margins because they blanket neighborhoods and the drive time is very little. That said, usually their marketing is higher than other types of marketing, and so that will take a bite out of the P&L in a different area. But if you can get that gross margin to 60% or better, that's awesome. But 50 to 55% is where we want to be. Okay, so action points. Consider raising your prices to decrease your break-even point, right? If you raise your prices, as I explained, you will decrease the break-even point because your gross margin rises, or if you improve your route efficiency, you will decrease your break-even point for the same reason. You're going to increase your gross margin. Okay. Now, let's take a look at, so it's easy for me to sit here and say, hey, why don't you raise your prices? But how do you raise your prices? So the first thing you have to do is identify what prices need to be increased. So, and it's anything less than our standard hourly rate. So in the prior slides, if we said that $166 is the hourly rate that we want, if we have an account that we service and it takes a half hour and it's at $83, right, then that account is priced properly. We don't need to increase it at all. But what you'll find is, and I'll go into how we get this information, but what you'll find is that you have a lot of accounts that are less than the standard hourly rate, and those need to be increased. When do I suggest increasing prices? Usually the anniversary of the date of the contract. So I like to do price increases every month for customers that came on during that month in a prior year, okay? How much do you raise your price? It's the difference between the standard hourly rate and what's currently charged. I cannot tell you how important this is. For anybody who listens to our podcast, it's PMP Industry Insiders, we've been pounding the table that you've got to raise prices to keep up with inflation. For anybody who's watching we do a monthly Pest index with William Blair. It's an investment bank. And what we're showing is that in August, the industry year over year increased by 18%. And you say, geez, Dan, that sounds like a lot. The economy's going into, a rough period. How did it get to be so much? Well, remember, that increase is a function of all of our clients. We have about 150 clients in that index. And on average, they've raised their prices about 10%. So that 18% really is only 8%. But this is really important because we know that the consumer price index is up by about 8.6%. That's the inflation rate. But that's not true for our industry. You find me, labor is up 20%. Fuel until recently was up 100%. And materials are up significantly too, which makes the inflation to the pest control operator more than that 8.6%. So it's extremely important that you think about raising prices and do raise them. By the way, for our clients who have raised prices, they were a little gun shy. I can't tell you one client that said that they got much in the way of pushback. In fact, everybody's raising their prices right now, so I feel like this is a unique time in history where you can raise your prices and you won't get much pushback. Okay, so the 3 steps to increasing the prices: identify which customers are cash cows and those that have a price increase coming their way. In other words, if your number's 166, if it's less than 166, they get a price increase coming their way. So basically, what you need is a breakdown of total customer base correctly priced versus incorrectly based on time, including retreat time versus charged for the year. Now, in PestPac in particular, you can actually go into each client and go into the history, and you can actually see what your dollars per hour are. Don't forget to include your retreat hours. That's extremely important because you may sell that quarterly account for $100 a quarter, and you're making $100 an hour, assuming you spend an hour there. But some customers will never have you back for a retreat. Some customers will have 1 or 2 retreats, which are probably your fault, which are probably normal. And then you'll have some customers who have 20 retreats because their tolerance for insects is, very low, and so they have you back. And so you need to increase those prices. And so even though everybody starts out with that $100 quarterly, in a couple of years, you're going to have pricing differently. Think of it like your electric bill, right? Some people use a lot of electricity and get charged a lot by the electric company. Some people keep their heat on at 65 and turn off all the lights and whatnot, and they don't get charged quite as much. It's the same thing. How much are you using? This is a true subscription model, and it's what's making the pest control industry so powerful because we have the analytics to do this type of laser-focused price increases. So once you get all of that out, then you enter the new price for each customer in the computer. Okay. Now, what we like to do, so we do price increase projects for our clients. If you're a PestPac user, you can do it yourself. But if you don't want to get your hands dirty and take a bunch of time, we can do it for you. Just give us a call. But basically, what we do is we take a look at all of our customers, and then we break them down into categories of how much the customer, what we're presently billing for their services, what we need to add in order to bring them up to our acceptable dollars per hour and the average increase per invoice. Then what we do is we give you a, the number of customers that need to be changed. And by the way, you can do this yourself. All this information comes right out of PestPac. Okay. And then we do an analysis. Okay. So 18% of our customers are not performing and need price increases, 3% are average, and 79% are performing. So this is a pretty decent company. By the way, the first year you do this, it's going to be a windfall to your bottom line. Year 2 and after, it's going to most clients are going to price properly, with the exception of the new accounts that you added since you did the prior price increase. So it'll be just the current year. Okay. So that's the most important thing about gross profit. We want it between 50 and 55% on average. We also want in order to keep that gross profit, we want to make sure that our routing is efficient, that our pricing is proper, and if our pricing is not proper, that we want to do price increases. Now, the next important thing, which is very important to anybody who owns a pest control company, is annual cash flow to ownership, right? And that's a little bit different than EBITDA or net income. So EBITDA is earnings before interest, taxes, depreciation, and amortization. And for a public company or companies that are not run by families or whatnot, it might be pretty accurate. But what we tend to see is that a lot of companies, there's a lot of owner items in there. The spouse's vehicle and fuel, travel and entertainment, certain administrative costs, other items. Those are all add backs, and they need to be added back to that EBITDA, okay? And so what we're trying to do is say, how much does the owner get to take out of the company, right? And we call that adjusted cash flow or annual cash flow to ownership. And the reason that it's important is obviously we want to make a profit each year so that we can pay our bills. We get, a paycheck so we can, pay our mortgage and our food and everything else. But also we want to understand what the value of that stream of cash is, right? So business is an investment, right? And we want to know what the value of that investment is, or what return we get on that investment. So is it current income or an investment? So you look at your pest control company with two lenses. The first one is the current income to owner that pays off your monthly bills, your mortgage, your food, your kids' tuition, whatever it is, right? And the second bucket is that terminal value, or I like to call it, your 401k. If you worked for IBM or AT&T or something, you would have this big pension plan, hopefully, that by the time you retire, that becomes yours in retirement. Well, the value of your business becomes your retirement. So the idea is to maximize the value of your company, and you do that through making sure that your gross margin is up to snuff, but also that your annual cash flow to ownership is. So let's take a look at an example or two. So let's say I have an investment that yields $100,000 a year. In other words, I have this store of value, and every year it gives me $100,000. If I needed to earn 10% on my money, that investment would be $1 million, right? 10% of $1 million is $100,000, right? Let's say that I have that same investment at $100,000, but my requirement is 20%. So that means that my company is only worth $500,000, or my asset is only worth $500,000. And it's really important that you understand that this is how businesses are valued, but also how you are judged, right? And depending on who's valuing the company, that 10% or 20% is extremely important, because that is their required rate of return. So one person could say, well, your company's worth $1 million, and the other person could say it's 500. The guy with $1 million using these facts is only looking for a 10% return. The guy at 500,000 is looking for a 20% return. Now, why is this important? Let's say I'm looking to buy your company, and my bank tells me I can borrow money at 5% and that your company nets $50,000. Well, the entire $50,000 goes to pay the interest at $1 million purchase price. But what about some return to me for putting the deal together and operating the company? Well, in this example, there is none. But let's say that I'm willing to accept 5% for my efforts plus the 5% for the bank. This would make the company worth $500,000, right? Or 10 times free cash flow. By the way, this is how sophisticated buyers look at companies. When you read the magazines and you hear people in the bar after Pest World or whatever talking about the valuations, they say, well, this company got 1x or 2x or 3x on revenue, right? But that's not the way that sophisticated buyers value it. They value it as a multiple of this free cash. So let's say that my business is kicking off 20%, right? A 3x would be 15 times free cash, right? Because 20% times 15 gets me to that 3 multiple on revenue. So that's the way you should be looking. By the way, you could sell your company, you could pass it on to your kids, whatever it is, but you want to have the best-in-class company, and the best-in-class company usually will drop 20% to owner, okay? So what does it all mean? Market interest rates affect firm value. It's why the stock market was higher and now is getting its butt kicked, right? Because interest rates are going higher. It's why real estate values were higher and they're starting to come down because interest rates are higher. It's why the price of other alternative assets were higher and they're starting to come down. This is all because interest rates are rising. So what happens if interest rates rise? Valuations fall. It's happening before our very eyes. Just look at the stock market, okay? And also look at the market for pest control companies. Anybody who is a student of pest control knows that there was the largest merger in history. It was Rentokil and Terminix. When that deal was announced in December, the stock market was at an all-time high. Remember, if you were a Terminix owner, or you owned a share of Terminix, you got 1.06 shares of Rentokil plus $11. At that time, this deal was valued at 3.6 times revenue. However, when it closed the other day, because Rentokil stock, along with the rest of the stock market, decreased significantly, that deal is only worth 2.6 times. That's startling. But it happened right before our very eyes, and it happened in less than a year. Lucky to say that the deal did happen, and we, will see, how that combined company operates over the next few years. So, action point. Best-in-class pest management companies drop 20% to ownership or better. So, you want to have a 50 to 55% gross margin and a 20% or better net cash to owner. It doesn't mean net income. It's EBITDA plus add backs of owner items, okay? Now, recurring or non-recurring revenue. That's the third point that's going to make or break you as a PMP, right? So recurring to non-recurring, it's predictable. Businesses operating on a subscription-based model rarely miss their monthly forecast because their financial forecast models are so accurate. In other words, I look in PestPac and I look at my business valuation report. I look at that every month. And what that tells me is that if I don't sell another account and I have 0% attrition, that's what my revenue will be for the month. Imagine operating a candy store. You don't know how much candy you're going to sell. You don't know what the weather is going to be, so maybe that'll keep people away from your candy store because they have to walk in the rain. There's so many factors that affect one-time businesses like retail that don't affect or have less of an effect on a subscription-based business like pest control. It's why all these private equity companies and Wall Street are starting to look at our industry and go, oh my gosh, what an awesome industry, and they're looking to get in. So basically, the gist is for recurring to non, instead of starting from zero, a company begins with a base to grow upon at the beginning of each period. Company owners and potential buyers are rarely surprised by major fluctuation in the business results, and the predictability of monthly subscription comes with a range of downstream benefits. It's easy to budget. If I know what I'm going to do for the month or the year, I can tell you how many trucks I need. If I can tell you how many trucks I need, I can tell you how many technicians I need, and you know how many uniforms I need, et cetera, et cetera. And it's a path to growth, and you get a higher valuation of business. Now, it also allows you to scale, right? So if I have a company that does $1 million in one time and $1 million in recurring, and my recurring, I have attrition of 15% per year, that means year two, I have $850,000, right? So if I want to grow 10%, I have to make up the 150 plus 10% to get me to $1.1 million. The company that has no recurring revenue, if he wants to grow or she wants to grow by 10%, they have to sell $1.1 million of revenue because there is no recurring revenue. So it makes it much more difficult. So this subscription model lends itself to scalability. Okay. And again, it helps with expense management, which is what we spoke about before, right? If I know how many trucks I need, I know how many technicians I need, I know how much fuel I'm going to use, I know all of the various types, because it's nothing more than a puzzle, right? So it makes expense management much easier, okay? Now, it also gives you the visibility. As we just said, unexpected changes in business won't completely blindside you if you know where you start each month and where you can expect to end up. So thanks to recurring revenue, you can make business decisions a year in advance. If unexpected changes occur, there will be plenty of warning and time to adjust. That's why it's so powerful. And it makes it durable. So with monthly recurring revenues, you never start a month with zero. Thanks to accurate forecasting and in-depth insights, you can use the collected information to reduce risk when making important decisions regarding taking on new business or reducing churn rates. Again, from this perspective, my single favorite report in PestPack is the business valuation report. It's outstanding. If you don't use it, you should. And if you use it and the numbers don't look right, that means that you're recording something wrong, and you probably should call WorkWave to get that sorted out. Action point. Every business should have recurring revenue woven into its core. If you're not thinking along these lines, you're putting the future of your business in jeopardy. Okay? And let's just talk about an example. This is recurring revenue, make your business pandemic proof, a very powerful example. So I'm going to come up with, I've got these two companies. First company has 80% recurring revenue, and the second company has 50% recurring revenue. Both companies do $3 million a year in annual revenue, or $250,000 on average each month. 250 times 12 is $3 million. So the monthly recurring work at the 80% level is $200,000 a month, and the one-time work is $50,000 to equal $250. But it's the 50% recurring work, it's 125 of recurring and 125 of non-recurring. Let's use my 50% gross margin and a net profit of 10%. And so at a 50% gross margin, that means that half of the 250 is direct costs, or 125,000. So I have a gross profit of $125,000. And that's the same for both companies. Really doesn't matter. And my monthly fixed costs, let's assume that they're $100,000. So that means that both companies make $25,000. So example 1 and 2 line up perfectly, right? They sure do, and all is good. However, let's jump a little forward and say there's an economic slowdown, a financial meltdown like in 2008 and 2009, a major geopolitical event like 9/11 where the country seized up, or here's one that was on no one's radar 3 years ago, a pandemic where they told you got to stay in your house and you can't come out, right? So what happens when something like that happens? Usually your one-time job revenue will dry up, as well as some recurring revenue, right? So if you remember, what was it, March 20th or so, 2020, when the government basically said, okay, everybody has to stay at home. We're in a pandemic unless you're an essential business. But they didn't define us as an essential business right away. It took a little bit of time. So everybody was in their house and all the one-time work dried up. Most of your recurring revenue stayed because people aren't thinking about that. So, that's where, that's where that goes. Okay. However, let's assume that a pandemic happens, the government shut down the economy. Thank goodness pest control is deemed essential. Citizens get scared, not making any purchase decisions until there's some clarity in the economy. Sounds far-fetched, right? Yeah, but we saw it happen, right? As a result, let's assume that 80% of the one-time work dried up. Let's also assume that we get a 10% skip rate on our recurring work, okay? Now, let's go to the next slide. So if you remember example 1 and 2, the first on the left, the first two companies, we made $25,000 profit on $250,000 in monthly revenue. However, with my 80% recurring revenue, if 80% of my one-time work goes away, right, then I am left with $10,000 of one-time work. And if I have a 10% skip ratio on the $200,000, I have $180. So my total revenue for the month is $190. In the company with the 50% recurring revenue, that means that my monthly recurring work, we lost 10% of that, so it went from $125 to $112,500. But my $125,000 of one-time work, I lost $100,000 of it. So in this example, the guy who had the 80% recurring revenue, the numbers, the revenue for the month was $190,000. The one with the 50% was $137,500. Using my gross margin at 50% and my monthly direct costs at 50% and my gross profit at 50%, basically what happens to pay my fixed costs off, the guy who has the 80% recurring revenue only loses $5,000 for the month. The guy with the 50% loses $31,250. This is the difference between a recurring and non-recurring business. Okay, so example 3, monthly loss of $5,000 hurts, but not the end of the world. That's this one. And then example 4, losing $31,250. This was a real client of ours, and they were in real trouble for several months. Okay, so the idea is, why is recurring revenue powerful? Look, how many times are we going to have a pandemic? Probably never again in our lifetime. But other things can happen, and they do happen. And so that recurring revenue makes you durable and scalable and makes for a terrific business model. Okay. So what we've talked about so far is that gross margin is important, net cash flow to owner is important, and then recurring to non-recurring is important. And then the last thing is growth. And let me put a caveat on that. Profitable growth, right? Not just growth for growth reasons. The reason that growth is important is if you have profitable growth, it will add to your profitability. It will add to the valuation of your company. It will provide more customers and look good for your customers and your employees. It will add to their satisfaction of working for a place that's growing, that good things are happening, etc. Okay, so let's talk about profitability. The more you grow revenue, the more likely you are to grow profits. If you achieve higher levels of revenue and manage costs so that they rise at a lower rate, then you maximize profit. That's part of that gross margin. If you can keep your gross margin at, say, 50 to 55% and keep your fixed costs fixed, as you increase revenue, you start to make much more in profits. By driving revenues higher, you improve profitability of your business. And revenue growth becomes an engine for investing, acquiring new talent, new capabilities, more products, other companies, expanding and attaining even more growth and profit in your business. This is how pest control companies grow, and some grow to tremendous size. Okay. Valuation. The valuation of your company becomes a currency to enable strategic decision-making in your business. Hey, if you want to sell your company, obviously you want it to be worth as much as possible. The valuations that others assign to your business determines your ability and flexibility to make important transactional decisions, such as selling your company. But also, let's say you want to expand and you want to go to the bank, or you want to go to an investment company to invest in your company or lend you money. It's going to be predicated on the value of your business. And so what you're trying to do is increase the value of your business, and growth is one of those key drivers. The rate of growth is also important. The trajectory of your revenue growth reflects the future strength of your business, and an accelerating rate of growth is viewed as a positive indicator, and a negative, if you're going backwards, that would not be a good thing. That's a negative indicator. Customers, in an increasingly customer-centric business climate, in other words, customers want to know who you are, what you stand for, how your business is run. They want to be engaged. And so they want to be engaged by a company that is doing great things. And companies that are growing, more times than not, are doing great things. Companies that are going backwards, you don't see them making investments in charity, or it's not, your job security or raises. Those aren't there. But companies that are growing, all those things happen. So growing your revenue in your business is a testament to your effectiveness in delivering value to your customers. Revenue growth is a key metric of your success in satisfying customers. They buy because they expect to receive full value from what you provide. And when they continue to buy, they're affirming that you are delivering them a solution that they need. So growth is an indicator that customers believe in what you're doing. Just as employees, growing your revenue is important to your workforce, right? Growing companies, employees expect to benefit from a business that's growing, improved wages, career path opportunities, management performance, bonuses, etc. Growing revenue drives more profits that enable investment in your workforce and also in your company to grow it. Knowing that their company is succeeding, demonstrated by growth in revenue, is evident to your employees that their work is impactful and that they're contributing to the success of the endeavor. Okay. Now, that is the end of my presentation. We have a lot of knowledge base on our websites. There's articles, there's videos. The accounting website is PCOBookkeepers.com, and then the business valuation and or exit planning website is sellmypcobusiness.com. Even if you don't want to sell your business, you should be on that website to look at the growth index that we do with William Blair and some of the other articles and whatnot. So those are two resources that we have available for you if you're interested in looking at some of the other things that we do. And with that, Danielle, I will push it back to you.
Great. Thank you, Dan. Before we get into the Q&A session, you can now submit those questions in the Q&A panel if you have any. I will turn it over to Lindsay Hardy for a few words about our sponsor, Pest Pack by WorkWave. Lindsay, over to you.
Yep. Good afternoon, everybody. My name is Lindsay Hardy, and I am an account manager on the Pest Pack side for WorkWave. So on this slide, you'll see here just what I will be covering today. I'll talk a little bit about who WorkWave is as a business, along with what our offerings are for Pest Pack, as well as what types of businesses Pest Pack does serve. And then also, I'll lastly cover one of our modules, which is the business analytics, and kind of really how it will help your bottom line. Okay, so first we'll get started. Who is WorkWave? So this is our mission statement. WorkWave is we're an empowered service-oriented company, or I'm sorry, we empower service-oriented companies to reach their full potential through scalable end-to-end software solutions that support every stage of their business life cycle. So we will help grow your business, service your customers, and maximize your dollars. Next slide. So some of our PestPack offerings, we offer a full suite of solutions that power the best in the pest control industry. We help grow your business again, service your customers, and also, again, maximize your dollar spend. So the types of businesses that we serve are, PestPack offers a robust functionality, flexibility and scalability that benefits both small to mid-sized businesses, as well as some of our enterprise-level pest control companies as well. So we offer our main solution, which is called PestPack, but then we also offer something called PestPack Lite, which is really used for more of the very small to, small business customers who are really just getting their feet wet within the industry. Same type of solution, just a little more out of the box. Next slide here. So how does PestPack's business analytics tool help me build a business that will last? On the next slide, you'll be able to see that we also have included a testimonial from one of our customers who is the owner of Cowley's Pest Services, who services pretty much all of New Jersey. And basically what he's saying here is PestPack really tells him what's going on inside of his business and all of the different areas that need measurement and improvement. And, it will also let you know your numbers, and PestPack allows you to know what's going on inside of your business, which is, of course, a critical piece when owning a business. Next slide here. So this is discussing what our business analytics tool does. So business analytics gives our customers visual insight into the data that they would need to evaluate to make better decisions for the business overall. So it can significantly improve your sales, it can increase customer satisfaction, and it will also boost your employee productivity immediately. So what can business analytics do for my business? So like I mentioned earlier, it will improve your bottom line. So there's two different types of views for business analytics. One is the financial dashboard, and then the other is the operational dashboard. And again, they provide high-level insight, offer easy drill-down capabilities, and enable you to take immediate action to get impactful results for your business. So this is just, discussing the financial performance dashboard. So it includes snapshots into your revenue and how your business is performing. It'll also give the business owner the billing metrics insights that maximize collections and bring the most revenue. Also invaluable information to improve forecasting and customer service experiences. And then lastly, those retention reports to help establish further programs and budgets. Next slide here is the operational performance dashboard. So on this dashboard, you'll be able to really optimize productivity and profitability and improve customer retention, as well as review each technician performance, ensure that jobs maximize future revenue, and then also ensuring that technicians are driving revenue and not expense. And then lastly, reducing costs and maximizing tech productivity overall. Yep, so this is a QR code that you guys can feel free to scan, and this way we can discuss this one-on-one with myself or with one of my team members, and we'd be happy to give you further information and show you a live demo of the PestPack Business Analytics. Last slide here. Any questions? I believe Danielle will be taking it from here to tell you guys where to put the questions in the Q&A box. Thank you.
Excellent. Thank you, Lindsay. Yep, at this time, we're going to jump into questions received during the live presentation and during registration. First up, we have a question for Dan. Is it more important to focus on rapid recurring revenue growth or maximizing EBITDA?
Great question. It depends on where you are in your journey, right? So I like to look at a company. I like to as I described before, your retirement or your 401k, or what is the company ultimately worth, right? So the larger your company is worth, assuming that you have a good recurring to non-recurring ratio and that you have high growth, the bigger the company, the more it's worth. So while you're building your company, the growth is extremely important. But if you want to harvest your company, meaning sell it on, you would also focus on your EBITDA. However, if your company is growing quite large and you get all the money that you need from it, but there's money left over, you can pour that money back into marketing and grow it even further. So it all really depends on where you are in your journey and what you're looking to get out of it. You can definitely dial back growth and dial up profit, or if you're going to dial up growth, you're going to dial back your EBITDA or your profit.
Great. Thank you, Dan. And thank you both, Dan and Lindsay, for your great presentations today. We will go ahead and wrap up the live event. I want to thank everyone for attending today's webinar, Is Your Business Built for Success?, brought to you by Pest Management Professional Magazine and our sponsor, PestPack by WorkWave. A recording of this webinar will be emailed to you tomorrow and posted to mypmp.net/webinars. Other upcoming webinars from PMP will be posted to that page. Thank you all for attending, and we hope you'll join us again soon for another great webinar.